Little one Paul here. Today I'm going to be making a video on a strategy. Now, if you see my last video, I did it. I did this strategy on. I did it on the hour time frame, and that's good for finding. Doing this strategy for like doing it on a weekly, or finding the signals. But for the strategy today, I'm going to be doing this. We're going to be looking at the daily, and now doing this on the daily, it's going to take longer to find these results. But there's certain indicators in there that will help increase your chances. Doing it on the daily here is what's going to make you more over time. The only negative to doing it on the daily here is you'll have to wait a while for the signal. So what I want to teach you guys is how to use this strategy for SPY, and it's using the it's using the 20, the 21, and the 90-95, and using it on the daily with another indicator to kind of help find some really. You can find those moments where an asset is actually going to be moving up for longer periods of time. So you have to look for that with this strategy. So I'm going to teach you how to set it up and what to look for when trading SPY. Okay, so to set this up, you need 4 moving averages. So I use Ghost Market Pro for the 90-95, but if you guys don't want Ghost Market Pro, you're going to have to. I'll show you a workaround. But first, you have to go to your indicators, and you're going to have to go to CM. You have to go to CM, EMA trend bars, and you click that twice, and you're going to be putting in 90 and 95. That will give you the thick thing on the bottom there. Now this acts as kind of like a major level of support, so that's what its use is. And then you'll need your 20 and 25 at the top. So if you just go here to 3 smooth moving averages, you can set it up. On one indicator, you have your 20 and 25, and you can check off the third one because you don't need it, but make sure you have your 20, 25. That will set you up with the 4 moving averages that you need. And then you need here in the bottom here is your difference of 2 moving averages. So if you go to difference of 2 moving averages, you want to change your setting here to 13 and 24. That's basically the setting that you need to make this work. And then, of course, you want to be looking at your day chart. So what you want to look for basically is you want to look for the last. Now, we're on the day chart of SPY. Now, to get these signals, you're going to have to wait a while. So you have to wait for them to cross. And sometimes it could have been a very long time before it crossed. We see that SPY, the time that the 20 and the 25 cross was right around here, which was on November 15th. Since November 15th, it has been going up pretty much. So SPY will enter into bearish territories when the 20 and 25 cross down with the 90-95. But that doesn't be looking to happening anytime soon. So what you want to do is basically, from the moment that it crosses, which right here, the trend has been going up. So the trend of it going up is what you need to be focusing on. So if you miss the direction of it going up, if you miss the cross, what you want to look for. Now, if you came in right here where the moment where it crossed, you could have rode this entire thing out, but you would have had to buy an extremely long contract to get where it is right now, and that's not what you want to focus on with this strategy. We know the overall trend is going up, so that's what you want to look at your EMA difference here for. Basically, every time this goes from a dark green, that's basically a put. Every time this goes to a light green, that's basically a call. So it tells you right out, and you can actually ride these for longer periods of time when you do find them. For right now, we see that it's dark green, so it's pulling back. So once this turns into a light green, we'll be able to enter a call and ride these out for longer than a day. So if we look back and we want to place calls, every time that this turns into a light green. So right here, we would start our call. Right here, we would start our call. right here would start our call. You would start a call right here, and then you would start a call right here. You would start your put right about here. You start your put right about here. Start your put right about here. And you start your put right about here. And start your put right about here. So once this turns into a light green, it's going to start the cycle of it going back up again. So let's just real quickly check these last couple times. When it started getting bullish here. So if you came in right here, came in right about here, and you rode this out, it's dark red and goes into light green. So if you came in right here, if you rode this out and you bought your contract for, this is 16 days. This one right here is a $23 difference in price in 16 days, and you would have made about $2,350. And then the next time you wait for, if you want to do a put, you can do a put, but they're not as big because that's going against the trend. So what I look for is, since we've identified the directions up, so we just enter every time that it turns into a light green. So that would be this moment right here. If we rode that one out, we would be looking at $2,416 in 20 days. So then you can do a put here if you want to, but it won't be as big because it's going against the trend. The next time to actually get in the trade would have been right here when it turns light green again, and you would have rode this out. You rode this out from here to here. This took 15 days to make another 20 difference in. It was a $20 difference in price. So this is about another $2,000 in 15 days. It pulled back a little, and if you look up at this pullback, you'll notice that the moving averages don't cross, so you know that you're still in an uptrend. Even though it dipped a little bit here, this would actually be a good entry point for when it comes back up, but you can wait till it turns light green again, which right about here. So if you entered right here, where it comes back up between the zero line, if you rode this out, took 12 days, and you made about this was a $38 difference in price in 11 days. This is $3,829. And then you got a couple more times here. You see it turn dark green, so there's a put right there. There's a call right here. And if you rode this out from here to here. So we want to look at this next one right here. We see it go down, and then we enter right about here. And if you entered here and you rode this out for, this is 14 days. It's right about here. All the way to the top right here. This is a $17 difference in price, so you made about $1,749 in 14 days. And then it goes down, so you can do a put if you want to, but that's going against the trend. I like going with the trends, so you just wait. It'll be a little bit of a wait. You can do against the trend. Now, if you did do against the trend right about here, you would do a put and ride that out. And this would be a $13 difference in price. So you can do a put if you want to, but I like going with the trend, so I just wait for it to go with the trend. And then you see you go back light green right here again. You enter here. You ride it all the way up to here. And this is about 10 days, and it's about $3,000 for one contract. So this last cycle that it's been on for the uptrend was right here. Right about here. You rode this out, you rode it out. And this is a $20 difference in price. So every time you're doing this, you're averaging it's usually about a $20 difference in price. Now what you can actually end up doing is, you can, every time you identify the direction here, and this just doesn't work. I mean, it'll work for SPY, but it can also work for all the other stocks. But You could identify the direction, which we saw. It was a long time ago. I think it was back in November. You can identify the direction, and every time it goes from that dark green to light green with the EMA difference, you enter your trade, but every single time you see that, you can scale up your contract. So all those moments where I saw you in was where I saw in the video where, you know, it's another entry point, you can go from one contract, then two contracts, then three contracts. We saw there was mainly about a $20 difference for each one of those moves. And every time there's another move like that, you can increase your contract. So the first time you can make about 2,000, the second time you can make about 4,000, and you can scale it all the way up, and you can get to eventually 10 contracts, and then eventually you can get to 100 in time. So this is a very scalable strategy, but the only disadvantage to this strategy is you got to wait for it to turn from the dark green to the light green. Now, in a bearish situation, which we didn't see with SPY, but you would basically be doing the same thing. So you want to wait for it to cross down with all the moving averages, and you want to be focusing when it's dark red, and you know, when it turns into a light red. So that's basically what you would do in that situation for a bearish situation. So anyway, this strategy is a good strategy for longer holds, for those that want to hold their stocks and their options much longer. Anyway, if you guys like this video, make sure you hit the like button, hit the subscribe button. I'll see you guys in future videos.